This is Brad Berry, Chief Investment Officer and Portfolio Manager with Dynamic Wealth Group. Welcome to this market and economic update. In this video, we'll discuss the recent stock market swings and how the unwinding of the carry trade in Japan may have worsened the fragility of the global markets. Markets recently experienced a spike in global uncertainty, with the VIX, which is the measure of volatility in the stock market, reaching a level not seen since the pandemic. This was due to concerns around the U.S. economic growth, Fed rate cuts, and tech earnings. However, it may have also been worsened by the unwinding of the Japanese carry trade. What is the carry trade, and how is it linked to U.S. stocks and global stocks? While it may seem complex, the concept of a carry trade is actually quite easy to understand. Carry trade simply involves borrowing money at a lower interest rate and investing it at a higher interest rate, thereby earning the difference in yields. This also requires buying and selling currencies, since the investor will often utilize government bonds around the world. In general, carry trades are more attractive when there is a large difference in interest rates and when currencies are stable. This chart shows the yield on a 10-year U.S. Treasury bond and the equivalent yield on a 10-year Japanese government bond, with the shaded blue representing the spread between them. It shows that the spread has historically been large, representing an opportunity for investors to earn strong returns through the carry trade. However, Japan has recently started to raise interest rates, while at the same time here in the United States, the Fed is expected to begin cutting as soon as next month. In anticipation of the spread narrowing, traders began unwinding their position, causing a drop in Japanese and global stocks as volatility increased. Next, this chart tracks major global currencies over the past 24 months, with the value of each currency re-indexed to 100 at the start of the period. As you can see, many of these currencies have experienced volatility over this period, but none more so than the Japanese yen this past week, as shown with the light blue line. When the Bank of Japan raised rates while economic data indicated that the Fed would soon lower its rates, the relative value of the yen shot up. The carry trade, which involves borrowing in currencies from countries with lower interest rates, in this case Japan, and investing in higher yielding assets, unwound rapidly, sending shockwaves across the global markets last week. However, the situation has since stabilized, and as you can see, the yen is beginning to trend back to closer previous levels. Finally, this chart shows stock market corrections and recoveries going back to World War II. Market corrections are defined as declines beyond 10%, but no more than 20% from the most recent all-time high. In the average correction over this period, the S&P 500 fell 14.3% from peak to trough over the course of about 5 months. Recoveries typically occur more quickly, taking just 4 months on average. Most importantly, though, these recoveries tend to begin when investors least expect them. At Dynamic Wealth Group, one of our core philosophies is not to attempt to predict the future, but instead to prepare for the future, regardless of what may happen. We target this by following our multidimensional asset allocation approach. Now, in light of recent technical factors driving markets, it's crucial for investors to remember that in the long run, markets are driven by economic growth and corporate earnings. These fundamental factors tend to propel markets higher over time, despite periodic setbacks. Now, despite recent market swings, staying invested in a truly diversified portfolio is essential to staying on track towards one's financial goals. We hope you found these high-level insights helpful. If you are a financial advisor and would like more information on our multidimensional approach towards asset management, feel free to download our eye-opening white paper titled Busting 7 Risk and Return Myths by clicking the link below or visiting our website at dynamicwg.com or emailing us at info@dynamicwg.com. If you are an individual investor, we are happy to address any questions you may have and put you in touch with a qualified advisor if so desired. Until next time, everyone, take care, make smart, logical, and fact-based financial decisions.